Nandan Kulkarni of Bernstein. He's Director India Healthcare and Senior Research Analyst at Bernstein. Great having you, Nandan. Let me first start off. You've got a slightly different angle to this. You're saying that in general, there's been an underpricing in the generic market in the US, and this could well be the trigger which the industry is waiting for. First off, give us that perspective, and I'll ask you a couple of follow-ups. It's a very interesting one.
Sure. And you're right. I mean, everyone has been simply talking about the short-term triggers as cost and how much difficult it is to make in US and so forth. Number one, a few months back, we have already seen that the drug shortage in acute categories has already started impacting US markets. We believe this trigger is going to amplify it even further in the near to midterm. One of the drivers being any potential tariff conversation which tries to move manufacturing onshoring will require a massive ASP upside revision to be able to sustain the economics. Economics in terms of labor, economics in terms of running the plant, and economics also in terms of getting the site transfer and filing the product with the FDA with the new site. All of that is going to trigger an intense revision of ASP, number one, and number two, massive competition, which will unfavor the smaller players, barring the exits. And that shortage is something that we believe is going to be an important detriment for the US patients, and therefore will have a substantial, interesting earning opportunity as well for a large Indian biopharma companies.
And this, you believe, Nandan, is going to play out over the next 1 year itself? That's the indication I'm getting.
Roughly 12 to 18 months, because if you see from a broad headline, today we understand that maybe the tariff will come in effect after 2 years. However, the preparation or stage towards it will be set much ahead of time, number one. And that window is about 12 to 18 months. Number two, if the tariff really has to come through in that effect, over the next 12 to 18 months, the negotiations with the payers and the pharmacy benefits will start for every single company who wishes to operate in US market, including the ones who have the capacity in US. And therefore, these dialogues are going to take effect in terms of shortage, prices, newer market structure over the next 12 to 18 months, rather than waiting for the entire tariff to unlock after 2 to 3 years.
And therefore, Nandan, how should one look at, if at all the tariff were to come through, first off, the next 2 years? Will it be led by, one is, of course, supply chain getting ironed out, as you are suggesting. And the second is also stocking up, right? Because it'll be at the fag end of President Trump's term. Whether that tariff actually sustains or not will also be something which will be in question.
You're absolutely right. And I always give an analogy of a moving chessboard, right? So number one, some of these advanced stocking and what we call strategic reserves will start becoming more of a policy narrative even for benefit operators, the PBMs in the US. And that will actually be a short-term trigger for improved demand for a large-scale generic manufacturers. That's first number point. So it's a pent-up demand before some event is anticipated. Number two, given that this appears, at least from a prima facie, a policy at a broader sense and not any section-specific investigations, there is enough chance of litigations and legal battle following through. And therefore, any outcome which is against proposing such tariff will again favorably support Indian biopharma not to commit a substantial capex at the beginning to go and onshore the products. So it might be a strategy of stocking critical products getting onshored for some time to balance out the supply chain risk, and at the same time waiting and watching as it is the fag end of the term, as you rightly said, to see what are the real fallouts beyond the narrative in terms of policy implementation. So I think that's how the equilibrium is going to move. And last point that we also alluded in our report is it's going to accelerate innovation-driven value in US further, especially for the large ones who will start continued focus on innovation-centric drug supply, maybe 505(b)(2)s, orphan drugs. Those are the pathways that will get further protected by the US FDA, and that is where the play will continue to double down. So I think that's how the variables are going to stack up.
Interesting. And you know, I want to understand two things. Is 2 years realistic and enough for onshoring of manufacturing and rewiring of supply chains for some of the Indian players? That's one. And this is obviously subject to the fact that they should have the available cash to do the kind of capex that will be required. But let's assume that they have that. The second piece is who structurally gains therefore and who structurally loses. If you can give us some color on that.
Certainly. Number one, in the report that we explained, I think 70 to 80% of generic volume that is in the US market today is simple tablets or solid orals in a technical term. Onshoring that is relatively a simple task compared to complex injectable or complex generic products. Now, at the same time, these 70% products are also operating on extremely thin margin. And therefore, beyond the cash, the question is sustainability of those operations on US onshoring, irrespective of who is trying to do it. From that perspective, companies such as Sun Pharma, Lupin, Zydus, who are actually present on the US soil today and running certain plants at certain capacity will find it incrementally attractive enough, number one, and number two, reasonably fast pace to do certain select tech transfers. And I believe within the 2 years, that is a reasonably achievable task, given last 20, 30 years of rich legacies that Indian biopharma and these companies have been operating in this market. So from that perspective, structurally, I like these stocks as Lupin, Zydus, Sun Pharma, who have this presence ability, and the 2 year time frame seems to be sufficient for these simple generics case by case basis. The second broader question to you on who might be in a not so perfectly well placed end, one of the answer, of course, is to contemplate about Biocon, because biosimilars by nature is not so straightforward as a business. Site transfers are more time consuming, rewiring supply chains are not easy, and Biocon's presence on that large category as of today is more centered from supply from Asia. And those will be a little bit challenging to navigate if the policy has to really material into tariffs in the full form that we are seeing today. So that's how I would look at the stack at this point of time.
Nandan, will the US digest this kind of tariff? Because there has to be, it's not realistic to expect Indian companies with niche products where you may not have alternatives in the US in terms of the supply to be saddling 100% duty. In that case, do you believe that some burden will actually get passed on to consumers in the US, which will actually put pressure to the fact that this entire rhetoric of tariffs on the pharma industry and generics is unsustainable?
Right. I think that's an important policy question, which of course will get debated over the next 12 months. As I said, once the pharmacy benefit managers, the PBMs, will start a rolling new wave of acquisition packages. But number one, certainly there will be a substantial portion, we believe, that will get passed on, given the margins are so thin in many of these categories that manufacturers will have no choice but to exit the market, which is not a win-win outcome for anyone, including the patients and the US FDA. Number two, in the pass on of these costs, out of pocket cost that will rise will also be kind of the factor that will have to be considered by the policymakers. And number three, therefore, most likely fallout that if somebody has to telescopically look at it, maybe selective tariff policy, as what happened in the MFN policy for branded drugs, or company to company contract signatures where certain products are incentivized selectively to be onshored at a company level rather than a blanket or a complete basket. So I think those nuances will start emerging, but there will be certain cost to the consumers that is inevitable if tariffs of this nature in this form today were ever to be conceived. That's our broad view.
And just talking about some stocks, right, Nandan, difficult to avoid counters and go stock specific. You know, Sun, Zydus, Lupin, they all have facilities in the US, right? So they're far better placed.
Right.
Who's the best place to kind of capture market share and take opportunity from everything that's playing out if at all tariffs were to be implemented, of course.
Right. Uh, I think if they were to be implemented, there is a manufacturing lens where I think we like these names. But beyond just the manufacturing, there is also an element of managing the channels in the new tariff era if it had to come. And that will pretty much depend on ability to go grassroots in terms of market, create a differentiated branding positioning. And I think that's where Sun is going to have, in our view, a substantial, a good head start given its massive Organon acquisition, which gives it a very strong footprint in the US in terms of channel and channel synergy, a good basket. And therefore, I think Sun will be one of the important and best placed stock to kind of play on this momentum in terms of reach out to the market.
Large one is obviously Aurobindo Nandan.
Right.
The understanding is you're neutral on the stock, but give us a sense if I've got that wrong. And what would it take for you to get more constructive with regard to an Oro? Give us a sense.
I believe Aurobindo has been doing phenomenally good job as a company to supply a massive amount of generic volume to the US and Europe for last many years. And one of the important company to have built structural chemical setup with backward integration, serve those markets where pricing is, as we said, very tricky. That strength is definitely going to be an important catalyst for Aurobindo in the case of tariffs, especially given that now they have Lanet in their basket in terms of manufacturing and then a large manufacturing facility back in India. I think they are one of the important lead runners to speak on doing things faster, taking it to the US market on your form of tariff. However, one of the only caveat where I would be a little cautious on Aurobindo is ability to turn around products on time, which has been a consistent problem and observation. So I think while there is a manufacturing capacity, a time to realize it in the market on time, getting that basket approved with consistency is where it's a continued struggle in some sense. And once that system gets bottom up transformed, once we see more of first time right products coming getting approved in ANDAs from Lanet or some of these facilities, I think that will be a good important point for Aurobindo to kind of transcend into a new category of a specialty complex generic player. So from that sense, the view is little neutral, positive sides, but little bit cautious on execution part from quality sense.
Nandan, we spoke with the management of Granules. They seemed very comfortable. Now, Granules is a company where nearly 50% of revenue comes from the US, right? And therefore, there's that dominant US revenue. But they seem very comfortable. They're saying we will pivot. How easy are some of these pivots in terms of having a US facility, diverting some of India production to the US, expanding the US facility, capex, balance sheet, and the like? How should one think of those pivots, if at all Indian companies have to make it?
Right. I will give you my comments more as an industry expert because the stuff you mentioned is not yet in my coverage universe. But having spent significant time in the industry, there are two important uh, observations or insight. Number one, as I was explaining, the solid orals to be one of the predominant categories, 80% by volume on these generics. Majority of these transfer require a simple batch structure, in vitro data, and an increased ability of in vitro in vivo correlation. I think those three things broadly are well placed for Indian biopharma today in a larger sense. Given last 20 years, we have been navigating US FDA policies. We have been making batch after batch. We have seen the recalls and then continuation of quality programs. So from that lens, my comfort is that Indian biopharma's intrinsic ability to navigate tech transfer is far superior today. And that's the confidence that I would get for an industry lens. That's number one. Second, my comment from industry perspective will be that when you think about balance sheet, majority of this capex we believe is going to be incremental in nature and therefore partly supported by these ASP revisions that we were speaking about. So when the new waves of manufacturing driven supply will come in, assume a post tariff era, I think the newer ASPs, because of the shortage, will start kind of funding some of these site transfers. And I think that is a catalyst which gives comfort to many managements moving forward that A, we know how to do it, and B, the cash is not going to be fully strained and consumed from the balance sheet alone. There is certain element of market rewarding to do so. And that's where the comfort will start coming in.
Last off, Nandan, if we're sitting in 2030, do you believe this is actually a positive catalyst from an Indian pharma standpoint or negative? And therefore, by extension, is the fall today an opportunity to actually go out and buy from a 3-4 year perspective?
I believe this is a very positive catalyst, and it is on a very two different dimensions why it is positive. Number one, it's going to hardwire Indian biopharmas to continue to be on the path of operational excellence in these uncertain world of supply chain, which makes balance sheets healthy, adoption of technologies, digitization, AI much improved. That was our view for last many months. And therefore, it brings better rigor on generating margins. That's number one in terms of positivity.
Please go
Number
ahead.
two, as we have been vocal, Indian biopharma is pivoting towards innovation, a very different incremental innovation. And this catalyst is going to accelerate it even at a policy level, like 505(b)(2)s, orphan drugs, complex injectable, peptides. All of those capacities and associated strategies will start getting renewed and fresh view from the management and from execution standpoint. So when I extrapolate all of this in 2030, our view is Indian biopharma is going to compound in terms of its innovation-driven earning, and this trigger may actually accelerate it rather than decelerate it. So I believe it's a very structured way to be along on this sector as a whole, and that's our view consistently for last many months.
Excellent. Thank you so much, Nandan. Thanks for joining us, giving us that perspective. Long chat. Thanks for taking on the time. All right. Time to switch for